President Cyril Ramaphosa said the declaration from this weekend's G20 Leaders Summit embodied a new age in multilateralism. South Africa's presidency has been hailed as a success despite a boycott by the United States of America. The United States has also rejected South Africa's agenda of helping developing nations transition to clean energy, cut their crippling debt costs, and adapt to climate change-induced weather disasters. Despite this, South Africa's G20 presidency has been lauded by many as a victory for the continent as a whole. CEO of the Southern African Times and the head of the Sankofa capital, Farai Muvuti, joins us now for more on this. Farai, good evening. Thank you so much for your time. Really do appreciate it. About 50 countries across the world now spend more on debt and debt service costs than they do on basic services. Most of those 50 countries are on the African continent and certainly almost all in the global south. This, of course, has been problematized at the summit itself. And so the commitment in the declaration to debt restructuring, debt cancellation, debt forgiveness, and debt renegotiation frameworks are an important move for some of these countries. And if that were to actually happen, the relief would be exponential for many countries on the continent, South Africa included. Is this likely to actually follow through?
Well, of course, thank you again for having me. I think the multilateral discussion around this perhaps raises this alarm amongst many capital markets, especially those in Europe that were well represented, and those in China, as well as those in the US. In as much as the president of the United States, was not president, but the United States business community was represented then. It raises the conversation in order for us to have a much more fluid way of working. Africa is the last frontier when it comes to investment. So it only makes investment sense, be it may lack the political will stemming from the fact that the US will take over. But I think with the political will, with the absence of political will, and purely focusing on what makes business sense, if you continuously charge growing economies such as Africa that are emerging with almost above 4% in terms of GDP potential growth as projected by the IMF coming from the global south, predominantly from Africa, it only makes sense for banks who want to grow their market base to have lesser lending and much more favorable lending terms. So I think it's a conversation around whether the visibility, of course, is around political will, be it given the fact that the US will be taking over the G20. But I think from a purely economical standpoint, the continent has managed to make a case, and that case is evidenced by data, but more fundamentally by the potential and future and growth of the global economic frontline, be it when it comes to the very economic development we hope to see within the world.
Let's talk about the African risk premium, because that seems to be the differential here that provides the sort of standard deviation on debt premiums, and of course specifically here the interest on that debt to be different to that of its European and Asian counterparts. How much of it is perceptive? How much of it is real?
Well, a high number of it, of course, is quite perceptive, but there is the reality that there are areas in which there is political instability, there is a sense of civil war, but these countries don't amount to at least 20% of the entirety of the continent. So I think this particularly needs to be looked at from a perspective of pure analysis that's driven by actual data. And I think the Africa Development Bank, our Outlook report, has consistently demonstrated how much of that's more perception than it is actual reality. And I think what financiers in the world need to start doing is paying a closer look at these particular markets within their independent right. But I think more so what the continent needs to do much more fundamentally, especially if you're looking at our hedge funds and our sovereign debt, as including our banking infrastructure, I think we need to see a much more multilateral approach as well in order to challenge some of these perception issues. Because if we work in silos, then it's going to be difficult for us to conquer that particular perception. But there is hope here, because if you listened to the head of Standard Bank, for example, in South Africa, Mr. Chabalala, who argued quite robustly about the need for African institutions, especially financial institutions, to be taken and looked at from an equal standpoint, given their own capital base. A number of our financial institutions are actually feeding within the continent. So you're not seeing a huge chunk of money coming as it used to be from FDI inflows, as is the case. You're seeing a lot of domestic investment generated from African investment itself, by African entrepreneurship. So I think that should be pushed. And that in itself argues against the sensibilities that risk premium is not what Africa continues to have a risk premium. I think it's purely colonial, and new data demonstrates that these issues are much more perceptive than they actually are reality.
Yeah, what will bring about a change in attitude within Bretton Woods institutions and foreign sovereign lenders, like China, for instance, which is one of the biggest lenders to African nation states on the continent, and of course, they weight the risk of a transaction based on what ratings agencies are saying. Standard & Poor has revised and continued to revise the risk profile and risk filtering system for all nation states equally, it seems, and we're beginning to see some of the dividends of that. But what will it take for, and you said earlier, political will, but how much exists within the Bretton Woods institution and major sovereign lenders?
So I think it needs to be joint. There has to be, one, a domestic strategy as to how we are dealing with our economic fundamentals within the continent itself, demonstrating that we are actually adhering to these, financial principles, as it were. But more importantly, I think it's important that we work collectively. I think the continent has a perfect opportunity given its market size. So market size itself makes an independent case for itself that we may not even need to convince the Bretton Woods institutions. But I think there are two aspects we need to look at. We need to look at our domestic fundamentals and then fundamentally look at how we are structuring deals, especially getting our institutions working in a much more collective fashion. It makes no sense that Zambia goes to China alone or Zimbabwe goes to China alone. It makes sense for us to have regional approaches as well as multilateral approaches through our regional and continental institutions so that we have greater leverage given the pure size of our markets. So that's one aspect. And we definitely need to drive the Africa free trade. This is the best thing that's ever happened to us. And without a clear, guided, logical way to build up infrastructure, respond to climate change issues as we're seeing, to deal with the issues of our sovereign debts collectively, I think we may be left behind. But in order to generate that political will, it starts with us.
The collective action lethargy that you're describing there is one that's particularly accentuated on the African continent. We don't see that in Europe. But that's because the bond yield market in Europe seems to be centralized around the European Central Bank. We don't have an African Central Bank. We don't have a collective or a singular bond yield on the continent. So there's nothing to which we can throw our collective risk behind and our collective upside behind. We sort of have to, and therefore we can't collectively approach China and say, hey, you need to treat us with this risk profile collectively, otherwise we won't do business with you. How do we overcome that?
No, we have tariff regimes amongst ourselves. We have bilateral arrangements amongst ourselves relating to trade. Those bilateral agreements, when it comes to our tariff regimes, if they advantage our local businesses and advantage our local institutions, in particular institutions relating to trade, that in itself can be a pivot for a big market such as China looking to invest. Remember, we in as much as we don't have the collective bond markets and sovereign funds and so forth, but we do have one thing in common. We have shared resources in terms of we all have strategic minerals. For example, if I'm mining steel in iron ore, for instance, in Zimbabwe, and China has a demand of 10 million, 10 million tons a year. If I band together with my partners in Limpopo, I meet those volume quotas, even from an SME perspective. So it's scaling up that potential to do business amongst each other, which we then can pivot our markets. But more so, even that said, look at just Standard Bank as an example, how much they've been able to grow into the African market up to the point of launching a structure in Egypt just, I think it was 2 weeks ago. That demonstrates market capability, right? So if we can strengthen our capacity to trade amongst each other, which is, of course, at a policy level, which is your tariffs, your entry barriers when it comes to policy frameworks, that creates an enabling environment for mutual trade, then you pivot that particular market base to extend to your external partners, such as your China, such as the United States. Because at the end of the day, when they're looking at the size of the market, collectively, we are much more bigger.
Yeah. Farai Muvuti, thank you so much for your time. Thank you so much for your insights. Really do appreciate it. Farai Muvuti is the head of Sankofa Capital.